All right. Good morning and good afternoon to all. On behalf of Saturna Capital and the Amana Mutual Funds, welcome to our call entitled Steering a Sturdy Ship Through Rough Waters. My name is Haytham Al-Sayed, and as your host and moderator, I wanted to thank you in advance for joining us and submitting your questions in advance. We will not be able to get to all of them during this call. However, we will make sure that someone from Saturna will get back to you regarding any unanswered question in a timely manner. As a friendly reminder, the call will be recorded and all lines will be placed on mute to avoid any background noise. So we have witnessed some rough waters in 2018 with a combination of GDP growth, lower tax rate, robust labor market, lower oil prices, record government shutdown, interest rate hikes, unknown tariff outcomes, and the list can continue. Hence, with Saturna's 30-plus year history of prudent asset and risk management, I'm very excited to share with you two special crew members helping us steer Saturna's sturdy ship. We will begin with Scott Climo, our Chief Investment Officer, who holds his Chartered Financial Analyst CFA designation and is a portfolio manager of the Income Growth and Developing World Amana Funds. We will be followed by Patrick Drum, a CFA, a Certified Financial Planner, and MBA holder designee, and portfolio manager to our fixed income funds, including the Amana Participation and Fund. They will provide an overview of the current market and economic environment as it relates to the funds they oversee, as well as answer as many questions as they can on this call. With that, I will turn over to Scott.
Thanks, Haytham, and good morning to everyone. Not the greatest day in the market today as we hold this call. A couple of companies had some disappointing numbers, and we're seeing that drag down the market as a whole. But despite that, let's just have a quick look at what happened in the fourth quarter and in 2018. Things started pretty rough in January, but then we started a nice little run-up over the second and third quarters before just rolling over aggressively. The S&P 500 shed something 13.5% in the fourth quarter of last year. And the thing that we were quite pleased with as far as the performance of the Amana Funds was that we often talk about downside protection, and that was provided in dramatic fashion, I would say, last year. For the 6 months leading up to December 31st, the Amana Growth Fund lost 1.2%, while the S&P 500 was down 6.9%, and the Morningstar Large Growth category was down 9.1%. That performance was repeated by the Income Fund, which lost 1.4% versus that 6.4% for the S&P, and actually 7.7% loss in the Morningstar Large Blend category. So the funds definitely came through as far as protecting and preserving capital in times of market distress. For the full year, the Amana Growth Fund did provide a positive return of 2.4%, while the S&P was down 4.4%, and the large growth category was down 2.1%. It was a difficult year for value funds and for Amana, so unfortunately that fund was down 5.2%, but again, the large blend category in Morningstar was down 6.3%. Something that we've seen over the past, really since the global financial crisis, is that value has underperformed relative to growth. It's very much been a growth-driven market and in many ways a technology-driven market. After the dot-com era, the late 90s leading up to the dot-com crash, it was pretty much the next decade was pretty lackluster for the technology industry. And since the global financial crisis, however, we've seen the Apples and Amazons and Microsofts have all staged really incredible runs in developing new types of technology-oriented businesses. So I'm sure that the question that a lot of people are asking is, what is the outlook for 2019? And one thing that we certainly don't feel very comfortable about is predicting what the stock market is going to do over any period as short as 12 months. But if we look at it from, say, an economic perspective, I think there are a lot of concerns. The government shutdown is a significant issue. But on the other hand, we've had some pretty good economic numbers. I mean, the job numbers that came out earlier in the year and the wage growth numbers were quite positive in terms of perhaps keeping consumer spending going, which we saw in the fourth quarter. And over the Christmas season, we had a very strong Christmas season. Consumer spending was up something like 7% year on year. So there is some, as long as you don't work for the federal government, there is some buoyancy in the consumer market, and so that's something I think we can feel good about. Interest rates were another area of significant concern last year, and a lot of people think that it was the continuation of the rate hikes that really helped push the market off the cliff in the fourth quarter of last year. We're not nearly as worried about that in terms of choking off economic growth as some others seem to be. I mean, from a historical context, the rates are still remarkably low. And, if anything, we would perhaps think that a little bit higher rates could, I think it's fair to say that the Fed has largely normalized the situation. And I think it's also fair to say that them having done so from the unprecedented place of quantitative easing and the zero interest rate policy is really a pretty impressive achievement, because really there was so much doomsaying out there about what was going to happen when the Fed had to normalize rates. And I think they've done a good job of managing that. And we actually wouldn't mind too much if we saw somewhat higher rates going forward, because one of the things that has happened is that the cheap cost of borrowing money, unsurprisingly, has encouraged companies to do so. And one of the things that is of concern to us is that the ratio of U.S. corporate non-financial debt to GDP currently stands at a record high, which is really remarkable when you look at the historical record that the level of debt typically declines during a period of good economic growth and solid sales, which we've seen for the past several years. And what happens is that debt spikes in recessions relative to GDP. So it's an unprecedented situation. It's something that, for 2019, we're not terribly concerned about, because we think the economy will continue to cruise along at a reasonable clip. It's probably something north of 2% GDP growth here in the first quarter. And so that's okay. But certainly, this economic growth is not going to persist indefinitely. At some time, there will be a slowdown. There will be a recession. Maybe it's 2020. I don't know. But then that's something that we would certainly be concerned about with regard to debt levels and the effect that can have on profitability in that sort of economic environment.
All right, very well. Thank you, Scott. With that, I will turn it over to Patrick Drum to share some of his thoughts on the fixed income side.
Good morning, and thank you. Thank you for all attending, and thank you for the introduction. So let's kind of talk a little bit high level here. We're all talking about where are we standing, what can we expect, and how are we managing risk? The focus here is on capital preservation. And what I want to stress and really communicate is how well positioned the Amana Participation Fund is in preserving clients' capital and while providing current income in a volatile market. And there's a lot of misconceptions, and there's a lot of narratives that are not necessarily true. So kind of want to provide a little bit of a walkthrough. Let's do high level. The fund currently offers at the end of December an SEC 30-day yield on the institutional side of 3.4%, on the retail side of 3.2%. The effective duration is about 3.4 years. It's designed to be high-grade, high-quality issuers. Last year was a difficult market, particularly in the emerging markets, as identified with Scott with the equity, as well as fixed income. That asset class, broad-based, we are finding in in an environment where broad interest rates are increasing, a stronger dollar, and for mostly the large part of last year, higher oil. Those three have created some destabilizing environment for risk-related assets. And as we've navigated this environment, as well as our company's history of navigating many business cycles, this is no different. The philosophy is going to stay the same. I can walk through a variety of numbers, but when you're looking at it, one of the best proxies is the Bloomberg Barclays GCC credit, both high yield and investment grade ended up being positive. While if you look to Asia, was negative. Broad JP Morgan EMBI Global Core was down 5.17. Really, we saw in a 6-week period ending 2018 is when we really saw a bit of volatility and liquidity issues come to the market. Most of the issuers originate from the Middle East to Southeast Asia. Continue to have a favorable and well-positioned outlook. In 2018, there was about 115 billion of Sukuk US dollar that were issued. Outlook is to essentially be at the same level, 105 to 115 billion by Standard & Poor's. The amount issued last year was slightly down by about 5%. Over the last several years, since the ending of 2016 through the third quarter of 2018, oil has precipitously continued to increase over that time period, and that has really provided the issuers and the sovereigns a meaningful opportunity to improve their fiscal balance, to include the fiscal budgets, to improve their overall capital requirements, and more importantly, to be better positioned. That region is at the beginning of a favorable business cycle. And in fact, the IMF has improved or raised the growth outlook for that particular region. There's other attributes that are going to position this region in a positive favor in 2019. JP Morgan announced formally that they're going to be adding 11% of the emerging market benchmarks, not all, but some, to incorporate securities being issued from the GCC. This is going to increase the inclusions up to 11%, with Saudi Arabia being the largest at 3.1%. What that means is that we're going to have a consistent and additional new incremental buyer. Ranges from anywhere from what I've been reading from 20 to 60 billion. The inclusion is going to be it probably will be ending or take place here at the ending of January, but it's going to be throughout a time period. It's not going to be an immediate investment. That's going to provide consistent and additional liquidity and support to the region. The potential pause by the Federal Reserve with regard to interest rates in March seems to be largely brought on as a consensus. That is very constructive as well to that particular region. Remember, this region generally lives on the dollar. Even though they have their own currency, it's pegged to the dollar. And so that permits that region not to be subject to some of the volatilities that we've seen in other emerging markets. So that provides a bit of an overview, but I couldn't be more constructive on any region when it comes to the Middle East.
Very well. Thank you, Patrick, for your informative updates. At this point, I would like to ask the portfolio managers some questions that came in. And again, thank you all to submitting a question. Scott, one of the questions, and I know you earlier in the call said, there's no way to really predict, but, is will we have a recession in 2019? And also, can you discuss a little bit about a correction versus a recession, if you don't mind?
The general consensus seems to be that the odds or the risk of a recession in 2019 are low. There's a variety of organizations that put out, for lack of a better phrase, recession meters that provide a percentage estimate for what is the likelihood of there being a recession, and most of the ones that I've seen so far are around the 25% range. So it doesn't seem to be, and it's something the Fed isn't predicting or projecting for this year either. So I think we're pretty comfortable with the idea that there will be continued economic growth throughout 2019. One thing that's important to recognize is that there's not a one-to-one linear relationship between economic performance and stock market performance. So, obviously the stock market performance depends on rising earnings, and a portion of that is dependent upon an expanding economy. But you don't necessarily have them moving in lockstep. So that's why we could potentially have a decent economy this year, and we may not have a great stock market, or vice versa. Those things don't have to be hand in hand. As far as I'm not exactly sure what you meant about between recession and correction, but recession is just 2 quarters of economic contraction, and a correction is generally some double-digit decline in the stock market. So certainly we saw a correction in the fourth quarter. If you measured the S&P 500 from its peak to its bottom, which occurred, I think, in the week between Christmas and New Year's, we had a 20%. We had over a 20% decline. So, and that's generally a benchmark for even kind of a bear market. And it was pretty sharp, and it was pretty significant. And I don't think that there's still a good sense amongst the investing public or the investing profession as to which way things are going to go in 2019, which is why we're seeing the type of volatility that we have been seeing. Friday was a very, very strong day, and today's a big down day, and we've been seeing that kind of up and down volatility for some time as people try to come to grips with what is going to happen for the next 12 months.
Okay, thank you. Appreciate that. We have a question that asks, a lot of analysts think that emerging markets are behind developed markets in their economic cycle. With that in mind, does Saturna agree with that view? And if they do you have a plan to invest more in emerging markets?
I would say that it's probably correct that they are behind the United States. I don't know if I would be so broad as to say developed and developing. I mean, countries are all over the map in terms of that. Some emerging markets, countries such as Indonesia, are pretty far along. Others, like Turkey, are very much are well behind. But even within a developed world, I mean, it's hard to say that much of Europe is at the high point of the cycle. I mean, they've been struggling for quite some time. As far as the investment opportunity in the emerging markets, if you look at the benchmark, the largest countries are China, South Korea, and Taiwan. And obviously, China's been in the news quite a bit. I think over the weekend I read 3 different articles, one from Bloomberg, one from the Wall Street Journal, one from the New York Times about the slowdown in the Chinese economy. And so that's obviously a market that performed very, very poorly. I think the Shenzhen or Shanghai index was down something like 36% last year. So that's a big problem. And of course, unsurprisingly, Taiwan is very closely tied to activity in China. So China sneezes and Taiwan's definitely going to catch cold. South Korea is a little bit more insulated, but still has some influence. So large swaths of the emerging markets are not particularly attractive right now. Southeast Asia is potentially a beneficiary of some of the things, particularly if there's increased trade tension between the United States and China. We'll probably see an acceleration of investment out of China and into Southeast Asia. Not necessarily countries that are that easy for us to invest in. Vietnam, for example, has been benefiting quite a bit from migration of activity from China. Bangladesh has been getting some of the lower end activity as well in textiles and other areas. So I have to say, and then I guess just to cover all the bases, I mean, South America, okay, Brazil maybe is showing some signs of rebounding, but I mean, Venezuela, it's not even a functioning economy. Argentina just can't seem to be able to pull itself out of the doldrums. Things are very tough there. So it's not an asset class that gets me tremendously excited for 2019.
Thanks again, Scott. I believe I have one more question geared towards your side of things. And the question is that what are your thoughts on investing in artificial intelligence? There's been a couple companies that have shined in this area as far as Apple and Nvidia. So the question is, what is your opinion regarding this topic as far as investments in artificial intelligence?
Yeah, I mean, artificial intelligence is a topic that's been garnering quite a bit of ink for some time. It's something that's difficult to exactly define. What does it mean, and what does it mean for individual industries? But we are seeing evolution from systems that simply provide data into systems that are able to analyze that data and parse it and create usable information for companies and for various activities. It's something that obviously is very closely tied to automated driving, for example. Pharmacy R&D is another area that's talked quite a bit about AI. So we think it's a real thing. We think it's pretty hard to define, and it's probably being somewhat overhyped. But it does fit into a thesis that we have going into the 2020s, which is that there is going to be a strong rebound in the semiconductor cycle. Those of you who have read our comments in the past may recall that when things were really booming in the semiconductor cycle earlier in the year, we kind of put out there, it's like, well, there's a lot of stuff coming down the road that's going to push that. Whether or not there's some correction of the cycle in between today and that happening? We can't really say. Well, obviously we have seen that correction. I think NVIDIA and Micron and companies of that nature have been absolutely crushed. But we still believe that the demand is coming down the road and that AI is going to be a big part of that. So as we move into 2020, as 5G wireless communications take off, cloud computing continues to grow, various artificial intelligence, augmented reality, virtual reality applications, we think we're going to see a real strong semiconductor cycle that could last for several years. And so that's something that we are definitely positioning ourselves for.
Okay, great. Thank you. Patrick, this question is geared towards your end regarding the participation fund and the performance since its inception, and maybe talk about its performance last year and maybe what you're doing specifically in the fund as far as, things that you're seeing, opportunities that may help performance-wise as well.
Yeah, more than happy to. So last year, as indicated, the institutional participation fund provided a return of 0.11% or 11 basis points positive versus a V benchmark that was 27 basis points positive. As earlier pointing out, and this is really the attention is emerging markets, particularly fixed income, and even more so the equity standpoint, experienced negative returns. This region was one of the only regions that I came across that demonstrated positive performance. And this is in part of the conservative nature and conservative approach that we employ. The issuers that we own in the region tend to be large, tend to have a long history, and generate on a standalone basis positive cash flow. So these are very large issuers. Their positive outlook, and the reason I am so constructive on this region is, again, this region is going through an economic improvement because it had since 2016, when oil-based recovered from the lows around the high 20 range, got as high as 70. And clearly oil has pulled back. Let's say range-bound mid-50s is kind of where consensus seems to form. This region is very astute in managing. They're very astute with regards to oil prices and oil management. And during the time of improved oil pricing, each of these countries improved their overall fiscal positions. You have quite a few positive outlooks that are hitting the region. You have the World Expo 2020 that's taking place in Dubai, the inclusion of 11% of JP Morgan's emerging market benchmark. That's going to be a large driver of institutional flows into this region. They are continuing to be a very strongly, or rather the issuance that comes from this region still obtains a high degree of coverage, and i.e. both by U.S. investors, European and Asian investors like this paper because it's high grade. Qatar, Kuwait have a AA rating. That's equivalent to the UK rating, even though they're facing Brexit. Saudi Arabia has a credit rating of A- equivalent to China. It's very few regions that have such a strong credit rating with strong capital reserves. They're small economies. And so as a result, our team really focusing on the issuers that have strong credit quality and good liquidity. And that practice isn't going to change.
Okay, very well. Thank you, Patrick, for taking that. So with that, we just wanted to say thank you all to joining our call today. We'll hopefully have more of these calls throughout the year. We hope you benefited from the call today, and I do want to thank both Scott and Patrick. Appreciate you being available to answer the questions. On behalf of the entire Saturna Capital Amana Funds Mutual Funds team, I thank you and have a great rest of the week.
Performance data quoted represents past performance, which is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than the original cost. Current performance may be higher or lower than performance data quoted. Standardized returns current to the most recent month end can be obtained by visiting www.amanafunds.com or by calling toll-free 1-888-732-6262. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Amana Funds and a current prospectus or summary prospectus, please visit www.amanafunds.com or call toll-free 1-888-732-6262. Please read the prospectus or summary prospectus carefully before investing.